Whether input tax credit can be denied to a bona fide purchaser under Section 16(2)(c) of the CGST Act merely because the supplier has failed to deposit the tax with the government. Hello everyone, I'm Aarti Maurya from DPNC Global. Today, we will discuss a landmark judgment from the Karnataka High Court in the matter of Instakart Services Pvt Limited versus Union of India. As we know that under GST, ITC is an important feature which allow a registered person to offset the output tax liability with the tax that he has paid on its purchases. But what happens when a supplier collects GST from the buyer and then simply does not pay to the government? That's exactly the case deals with. Now, let us look at the facts. Instakart Services Pvt Limited, a Flipkart company, have purchased goods and services from registered supplier, paid GST to their suppliers and claimed ITC. However, one of this registered supplier collected GST but did not deposit it with the government. The GST department then issued demand notice to the Instakart claiming that they were not entitled to claim ITC because of the suppliers defaulted. Now, the legal issues came before the court. First, are Section 16(2)(c) and Rule 36(4) unconstitutional and violative of Article 14 and other constitutional provisions? Second, should these provisions be interpreted narrowly to protect bona fide recipient? Third, does the law impose an impossible burden on the recipient for the supplier actions? The court examined legal provisions in this case. First, Section 16(2) of the CGST Act lays down the conditions for availing ITC. Second, Rule 36(4) of the CGST Act restricts ITC based on the details furnished by the supplier in their GSTR1. And here's what the court ruled. The court held that the Section 16(2)(c) and Rule 36(4) are not unconstitutional and the provision is interpreted narrowly so that it does not apply beyond what is fair and constitutional. Section 16(2)(c) cannot be applied to deny ITC to a bona fide purchaser who has complied with all necessary conditions simply because the supplier has failed to remit the tax. ITC can be denied only in cases of fraud, collusion, and where the transaction itself is not a genuine. The court held that the action should be taken against the defaulting supplier, not the recipient, and therefore set aside the impugned order. To conclude, this is a landmark ruling that provides a significant relief to the honest and bona fide taxpayer by ensuring that the ITC is not denied due to the supplier non-compliance that is beyond the recipient control. Section 16(2)(c) survives but only when applied fairly. It cannot be used as a weapon against innocent buyer. The copy of the relevant judgment is shared in the pinned comment. Please feel free to read through it for complete context and references. Thank you.